Spend less than you earn, invest the surplus, and avoid debt. This is a one-sentence summary of this book. Many people don't find investing or money an interesting topic and don't want to spend much time learning or studying about it. If you want to read a really small and simple book on investing, this is a great book. The Simple Path to Wealth is a book by J.L. Collins. It's about an easy way to manage your money and a simple roadmap to financial freedom. Money is the single most powerful tool for navigating this complex world. Therefore, understanding it is crucial. You must understand how money works, how you can use it to generate streams of passive income. If you want to become financially independent, you must at some point, sooner rather than later, dedicate a significant portion of your income towards investment. Hello, welcome to the Wisdom Inspired Talks podcast. I'm Yomi Akinpelu, your wisdom coach, speaker, teacher, and author of several books. Today, I'm talking about The Simple Path to Wealth by J.L. Collins. So let's dive right in. There are 4 key lessons in this book: how to think about money, why most people lose money in the stock market, investing is not complicated, and financial independence and freedom. Everyone can retire a millionaire, especially if they start early, says J.L. Collins. Instead of looking at your money and saying, "What can I buy with this?" look at your money and say, "How can I make my money work for me? How much can my money earn for me?" You need to see your money as a tool to make more money, not for consumption or purchase of depreciating things. Put your money to work, every dollar, every pound, or whatever currency. Your money is its own money printing machine because it has the ability to make more. For example, if you take £1,000, instead of spending it on the latest phone, you decide to invest it. Over 30 years, at an average rate of 7%, it will be worth over 8,000 compounded. So that 1,000 you spent is not really just spending 1,000, it's taken from your future. It's like squandering a future 8,000 in the present. So next time you want to spend, look at it this way. Is that expensive phone worth £8,000? Because that is what it will cost you eventually. When you are working, you are in your wealth accumulation phase. You need to be putting away money for your retirement. So you need to spend less than you earn and invest the rest. Pretty simple. How you think about money is so important. Money is not just for spending, it's for freedom. You can either spend your money or invest it. You can invest it and spend the returns, or you can invest it and then reinvest the returns. Every time you spend money, you must consider the opportunity cost. This is the fact that once that money has been spent, it can no longer be invested to produce or make you more money. So if you consider how much that money would have made you at about 8%, which is the average stock market return, compounded, that is money making money on money, this is a huge cost and it keeps increasing forever if you spent it rather than invested it. The second key lesson in this book is that debt is the most dangerous obstacle to building wealth. This is because debt allows people to buy things that they cannot afford. Debt makes you spend on pleasures you cannot afford or that you should delay till later. Debt makes you spend tomorrow's money today. This book deals quickly on the mechanics of getting rid of debt or getting out of debt. There really is a simple way of getting out of debt. Spend less than you earn, and with what you have left, aggressively pay down your debt as quickly as you can, starting with the debt that has the highest interest rate. Unlike Dave Ramsey, who says start by paying off the smallest debt, J.L. Collins says start by paying off the debt with the highest interest rate. J.L. Collins is looking at the maths, while Dave Ramsey is looking at human psychology. Whichever way, pay off the debts quickly. If you are spending less than you earn and you've paid off your debt, then you're going to have money to invest. So the next key lesson is invest what you have saved. J.L. Collins says, investing is not complicated. He suggests that you invest in 3 asset classes: stocks, bonds, and cash. For stocks and bonds, J.L. Collins says you should invest in a broad-based index fund with low fees. These are passive funds, not actively managed, because if you're paying someone to manage your money, you're probably wasting your money. J.L. Collins seems not to be a fond of financial advisors. According to this book, by investing in a broad-based index fund, your returns would very likely outperform the financial advisors. So invest passively by investing in index funds like the S&P 500, which contains the top 500 companies in the US, or the US Total Stock Market Fund, that is the top 3,000 plus companies in the USA, which is well diversified. J.L. Collins suggests the Vanguard US Total Stock Market Index Fund. When it comes to investing, you need to develop a stomach for volatility. We saw a market crash in 2008, and in 2020, the pandemic, and currently in 2022, a volatile market. Historically, a downturn is always followed by a bull market. So if you want to make money in the stock market, you need to be invested for the long term. You lock in losses when you sell in a downturn. Instead, buy the dip. This is like shopping in the sales, but much better. Events like market crashes and volatility happens all the time. So be prepared for it and stay the course. Don't panic. Don't sell or jump out of the market, or you lock in the losses. If you hold your stock for the long term, any downturn is just a paper loss, not an actual loss. Instead of selling off stocks during a downturn, buy more. Stocks are ownership of a company. So if you own many good companies, why would you sell them during a sale? The right thing to do is to buy more during the sale. And that is how you need to see a market downturn, just a sale, a time to buy more assets. A lot of people say that investing in the stock market is too risky. They don't want to risk their hard-earned money. And so the next lesson in this book is why people lose money in the stock market. The number one reason why people lose money in the stock market is because they think they can time the market, like they are fortune tellers. So when people stay out of the market, sit on the sidelines, waiting for a crash to happen, they miss out on all the growth and they are losing money just by staying out of the market. Most of the time, the market trends up. On average, when you stay out of the market, you lose money. Don't try to time the market. It doesn't work. Time in the market is what works, not timing the market. Number 2, people think that they can pick individual winning stocks, the hottest and the latest stock, and then they get burned. You hear all the adverts online saying, if you had invested 10,000 in Amazon in 1999, you will be a millionaire today. But how many people would actually have thought that Amazon would be a good investment? Same goes with many individual stocks. The chances that a single stock would do well is low. In the long run, people lose money trying to pick individual stocks compared to buying an index. Just like a single stock could go to the moon and increase, the same way you could lose all your money if you invested in a single stock. If you bought an index-linked fund like the S&P 500 or the US Total Stock Market Index or ETFs, then your stock will be well diversified and you are likely to have a good return. So don't look for the needle in the haystack, buy the whole haystack. That is, invest in an index fund. Number 3 reason why people lose money in the stock market is because they focus on the price movements and get emotional. When you invest in the stock market, you are buying a piece or a share of a company. You shouldn't focus on the fact that you spent £100 per share. and that share is now worth £50. You need to focus on the fact that you still have one share of that company. You still have your assets, which can always make money. So what makes people lose money in the stock market is that they buy stocks for, let's say, £1,000, and then when they see the stocks go down 20%, they think they need to sell and jump out before they lose all their money. And when they jump out of the market, they lock in that loss. That is one of the worst things you can do. When stock prices go down, all that is happening is a fluctuation in the market. Volatility is a guarantee in the stock market. So you need to understand that although the prices of the stock fluctuate, you still have the same number of stocks. And if you keep your stocks and don't sell off when the market goes up, the value of your stock will also go up. But if you allow emotions to make you sell off in a downturn, you lose money. What to do if prices go down is to buy more, not to sell low and buy high. I know that it is easier said than done. Sometimes you will need nerves of steel to ride the waves of the stock market fluctuation. Or better still, don't look at your brokerage account at all. Just put it on autopilot. Market crashes and volatility happens all the time, so be prepared for it. If you stay the course and don't jump out of the market, in the long term, you would reap the rewards. You will see your portfolio grow, and once you can live on 4% of your portfolio, you are financially free. A lot of people don't think about retirement until it's too late. You may be thinking, I've got 40 years, I've got 30 years before retirement. Well, this is the perfect time to start, because if you start now, you have compound interest working in your favor over a longer period. And time in the market is one of the most powerful factors that will determine your returns. Once you can live on about 4% of your portfolio, you are financially free. And the reason for this is because if you assume that the stock market goes up 7% every year, and assuming inflation doesn't go above 3%, if you retire at about 65 and withdrew 4% of your portfolio every year, you are still left with your original portfolio, or maybe with an increased value. So this is the Simple Path to Wealth by J.L. Collins. To be able to invest, you must control your spending as well as increase your assets. Financial independence is not just about being able to retire early, but having the options and the freedom to do what you want to do. You can choose to continue to work, or you can choose not to work at all. Now, this is not the only path to wealth, but it is a path to wealth, a really simple path. Yes, you can invest in real estate, start a business, invest in startups. There are all sorts of things you can do to make money, to retire early. But the beauty of this path is the simplicity. Invest in the stock market, buy a little bit of bonds, and let it ride the highs and lows of the stock market over the long term. That's the Simple Path to Wealth by J.L. Collins. And that is all for today. Please subscribe, like, share, and comment below. Thanks for watching, and see you on the next video. Bye.